Momentum is defined as the impetus gained by a moving object. We're going to look at how that applies to stocks. We're going to review some popular momentum stocks, talk about how this is used, and discuss pitfalls of its approach. There's also a fun exercise at the end. Now, to learn about momentum, we're going to turn to one of the premier research groups in the industry, MSCI. So they've developed what's called factors. These are characteristics that help explain the long-term risk and return performance of an asset. So what large institutional managers will do is they'll upload hundreds of portfolios into this tool that MSCI created. They perhaps renamed it. But back in the day when I worked there, it was Borrow One. And then that tool will then attribute your performance and risk across these various factors and show you where your exposures are, things like that. What they're trying to do with factor indices is capture the return of these factors so that portfolio managers can use them when making investment decisions. So size is very intuitive, right? You just get all the stocks in the world, aggregate them, and then split them into size groups. So that one's pretty easy to understand. Value and growth, we covered that in a past video, and it's a little bit more sophisticated. It's simple on the tin, but it can get fairly sophisticated. What they look at for momentum is quite simply 6-month price performance and 12-month price performance. And when they calculate those, they remove the last month of performance. So they don't include the recent month. The reason that they do that is so that they can take into account assets that may be on a tear and that are having a temporary correction. So they give them that little bit of a buffer. So once they calculate these values, then what they do is adjust them for corresponding volatility of the security. So the more volatile the security, the less credibility they're going to give to that momentum score, basically speaking. And we're going to look at an example of the opposite of that, where a historically very stable, low volatility asset has very good price returns over time. Then what they'll do is then some more statistical work. So they'll standardize those data points into Z-scores. Some of this stuff can be complicated. I remember sitting in rooms with hedge fund managers and PhDs, and half the stuff they were talking about was going over my head, and I just nodded along. But it's also quite simple. So, for example, Windsorization sounds technically complex, probably is, but simply put, it's just limiting extreme values. So all you're doing is trying to reduce the effect of possibly spurious outliers. So what you end up with then is a ranked list of stocks based on a momentum score, and then they multiply that score by market cap, and you can create an index or a portfolio. Now, research shows that, and this is from MSCI, momentum may not be as well understood as other factors, though various theories attempt to explain it. So if even the premier research groups in the world can't understand how momentum works, then as retail investors, we certainly don't expect to be able to understand that either. Now, some postulate that the outperformance of momentum, so this factor performs relatively well over time. They say that's compensation for bearing high risk. Okay, that's intuitive. And the other explanation might be that market inefficiencies produced by delayed price reactions to firm-specific information are what cause the outperformance. Well, a lot of the trading that happens out there is really just algorithms that don't need time to mull something over. That seems to be a less compelling explanation, but it is one nonetheless. Now, portfolio managers usually implement momentum by doing what we looked at, which is taking into account performance over the previous 3 to 12 months, omitting the most recent month, and then calculating a momentum score based on that. So there's other ways to do it than just the one that MSCI has that we've showed you. Now, Morningstar also comments on this and says that a theory behind the strength of the momentum factor partially reflects herding behavior. Investors tend to pile into stocks that have posted high returns in the recent past. So that makes one think about hype and how that how that gets reflected in a momentum strategy. We're going to touch on that in regards to particularly hype that's created by retail investors. Now, what you need to remember is that any strategy that targets momentum stocks is going to see high turnover, just because based on that, the way that we're calculating momentum scores, those can change very quickly. So frequently buying and selling stocks increases transaction costs and taxes. Now, how would institutional investors use momentum indices? Well, strategic asset allocation for diversification purposes. They may study the characteristics of momentum strategies. So they're of use to institutional investors. Whether or not retail investors want to dabble in momentum, it should be restricted to a basket of stocks in a ETF. And there's actually the iShares MSCI USA Momentum Factor. So it utilizes the calculation methods we discussed earlier. BlackRock owns the iShares franchise. We were very close to them at MSCI. They gave us a lot of business. This particular ETF has about $8 billion in assets. You can see how that moves over time. Look at the COVID dip there in 2020 where everybody moved out of this. Obviously, we want to take a look at some momentum stocks that's of interest. So here we have some. This is the MTUM iShares USA Momentum ETF, the top 10 constituents taken at different points in time. So the most recent there you see on the left, that was yesterday. And I've highlighted some names here of interest that I wanted to talk about. So if you read then to the right, you see the second table is from last month, and then the next table is from the month prior. And then the table on the far right, that's actually from December of 2022. So we can see how things have changed over the past year. Now, the first thing to note here I thought was interesting is Broadcom's ascent over the past 3 months. So you see how it's steadily climbing up the rank there. The other thing to notice here is the commonality of tech stocks across all 3 months. So you see that Meta, Microsoft, and NVIDIA are featured in all 3 tables, whilst other companies might be only in 2, such as Amazon in the first 2 tables or Adobe in the first 2 tables. But what's interesting is when you look at the only company that's in the top 10 from last year to this year is Eli Lilly. And what's interesting about Eli Lilly, and I didn't know this, they're actually the biggest pharmaceutical company out there, at least based off of their rapid ascent there in market cap. But look how low their beta is. So beta is just a measure of how this stock moves relative to a benchmark. So if the beta is 1, it moves the same. But low beta stocks tend to be to move in a less volatile fashion compared to the benchmark. So that's why Eli's persistence across time is quite remarkable. And you can see here from this stock price chart, it's a 5-year chart, it shows their steady decline or ascent over time. Now, when we look at the industry breakdown, this is the most recent picture of the MTUM ETF, 40% technology. And that's no surprise, right? When you see the tech names dominating the top there. It would be interesting then to see what this sector breakdown looked like a year ago when none of the big tech firms were in the top 10. Now, just a disclaimer before we go looking at some other names in the recent listing of momentum stocks. We believe it's a bad idea to go fishing through the MTUM stock list to find names to trade. You should be investing in companies, not stocks. Now, bearing that in mind, we went and looked for stocks that are on our radar and listed them all out here. So these are names that would be found in our tech stock catalog where we cover over 460 tech stocks. And as you can see, the NASDAQ 6-month return is along the bottom there, and the 12-month return as well. And then you can compare these names to those returns. So you can see, CrowdStrike, it looks like, has done over the past 6 months or 12 months quite well. Palantir is in there. Coinbase has just gone way up. And again, going back to the point about investing in companies, not stocks, I'm not sure why that is. There doesn't appear to be any obvious reasons for that. But The two names on the bottom of the list are interesting because the 6-month returns are actually negative. So Exact Sciences at minus 27%, Confluent at minus 26%. What might be happening there is that the previous month exclusion, when that was calculated for these firms, might have resulted in removal of that bad performance, or when these were last weighted, and I actually didn't look to see when they had their most recent rebalance, that the negative performance for those two companies was probably rather recent. So when it comes to CrowdStrike, so that's the only name on this list. There's an other name on this list we're holding, but we're holding CrowdStrike. And the question here, of course, is if it has this temporary momentum that we know that's not going to last forever, there's the temptation there then to try and time the market. We don't see any reason to do that with CrowdStrike, or generally speaking, any other stock. Though what you might see is, for example, when gene editing stocks went through the roof, and I mean, a couple 300% in 10 days sort of thing. When you see very obvious hype, I think that taking some profits off the table might make sense. And when that happened with gene editing stocks, I think we recovered more than half our cost basis when that event took place. I can't recall when that was. But for CrowdStrike, we certainly wouldn't look to do that. So let's look a little bit more on CrowdStrike's valuation here. And there you can see the price chart on the right reflecting the rapid increase in share price. But what we use here at Nanalyze is a simple valuation ratio. You just take market cap and divide that by the annualized revenues, and it produces a number. And we've plotted that at various points in time in this chart. And you can see that the average SVR using those data points is 14. And our current rules to buy at an SVR of less than 14. It currently happens to be 19. So this is quite overpriced. We actually don't buy stocks with an SVR higher than 3 times our catalog average, which the last time I checked was had moved to 6. So that means we wouldn't buy any stock with an SVR higher than 18. A good value for CrowdStrike would be an SVR of 10 or less, and you can see that earlier this year it traded at those levels. So let's discuss what we've learned so far. Simply put, momentum is positive short-term price action. We invest in companies, not stocks, so we're not going to go looking through the momentum list for companies to quote-unquote trade. Even the experts don't understand how momentum works. There's an intuitive reason to think that momentum may be tied to hype, though when you look at retail contributions to trading, they're only around the mid-20s in percentage. So what you might want to do then is dig into particular names, and meme stocks may be the better example of that, and see where retail investors are really pumping a stock. You can see that, for example, with Palantir alongside AI hype. The objectivity of a momentum strategy decides when to sell, because figuring out when to sell is one of the toughest decisions that investors will face. So I wanted to touch on that quickly. When do we sell stocks? Well, we sell dividend stocks for one reason only. If they stop increasing their dividends, we find another company that will. Tech stocks are a bit trickier. We sell when revenue growth stalls, and the question is, well, for how long? And we sell if the thesis changes. So in either of those cases, we'll sell. And both are subjective, and that's where we'll do plenty of research and analysis before we execute any sort of decision around those particular factors. We trim in our portfolio at around 11 to 12% weighting. We trim that down to 10%. We've had some internal conversations about whether or not to increase this limit. So, for example, maybe we raise it to 20 and trim from 20% down to 15, or we let an asset run until 15 and trim it down to 10. I think NVIDIA is a good case study to look at trimming. We've been trimming NVIDIA for a long time and have reaped quite a few rewards from that stock. It's still currently our largest tech holding. So on the topic of NVIDIA, a bit of fun. So go ahead and guess where NVIDIA stock will be at the end of this year. Put it in the comments section. Take it down to the cents. So, for example, you might say NVIDIA is going to trade at $420.69 at 2023 market close, the last day of trading. And then one of our MBAs is going to pick the person closest to that closing price and send them our analyzed new money report for free. You can see that on the right here. This contains 20 stocks, 10 dividend stocks we feel are most compelling. That's based on our Quantigen's Q scores and taking a industry diversification approach. We've also included 10 disruptive tech stocks. So even though we manage a portfolio of 37 stocks, people are always asking, well, what stocks do you find most compelling? And that was the impetus for putting this report together. And we picked 10 stocks that we think are most likely to survive and thrive across the various themes that we cover. And just the fine print here, you must be subscribed to our channel. Comment before December 22nd. We'll reply to your comment announcing your winning guess, so watch your responses. And our Romanian fortune teller may be participating in the contest, so just be aware that you're facing some stiff competition. So I'm going to put up another video here that you might be interested in. It's digging into this notion of when to sell stocks. It relates to today's video. So thanks so much for taking the time to watch this today. Make sure to put your guess on NVIDIA's share price at the end of this year in the comment section. Thank you.